Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup world. LAT Aerospace, co-founded by Dipinder Goyal and Surabhi Das, acquires a defense robotics firm, Sharang Shakti, in first step towards indigenous defense and civil aviation build-out. Canva acquires UK-based animation platform Cavalry and US video ad startup Mango AI to strengthen AI-led creation and professional design suite. Xflow raises $16.6 million in Series A, led by General Catalyst at an $85 million valuation, secures final PACB authorization as revenue jumps 10x in 2025. Wishlink raises $17.5 million in Series B, led by Vertex Ventures Southeast Asia and India, to scale creator brand partnerships and expand commerce tech stack. Paramount Skydance has submitted a higher offer for Warner Bros. Discovery, ratcheting up efforts to derail the HBO Max owner's deal with Netflix, says Reuters. The bidding war for one of Hollywood's most coveted assets, including the Harry Potter and Game of Thrones franchises, has raised the stakes for dominance in the streaming-led market. Chinese AI startup DeepSeek's latest AI model, set to be released as soon as next week, was trained on NVIDIA's most advanced AI chip, the Blackwell, a senior Trump administration official said, in what could represent a violation of US export controls. The US believes DeepSeek will remove the technical indicators that might reveal its use of American AI chips, adding that the Blackwells are likely clustered at its data center in Inner Mongolia, an autonomous region of China. On What's Brewing today, Dipinder Goyal's aerospace venture LAT Aerospace is making its first move into defense. The company has acquired Gurugram-based Sharang Shakti, an early-stage defense robotics startup focused on counter-drone systems. Shilpa Ranipeta joins us now with all of those details. Shilpa, LAT was originally founded with the idea of building short takeoff aircrafts for regional travel. But what does this move into defense sort of mean or signify?
Well, the acquisition of Sharang Shakti marks an expansion for LAT Aerospace into defense technology. Now, remember, Dipinder co-founded LAT last year with the intention of building short takeoff and landing aircrafts meant for short regional travel. To understand this better, let's look at what Sharang Shakti does and why this is sort of like, an extension into a different sector. Now, this startup was founded in 2023 and is an airspace surveillance and defense robotics startup based in Gurugram that builds integrated counter drone systems. Now, the company has also raised 5 crores so far in pre-seed funding in September 2024 from AUM Ventures and from Venture Highway, among other angel investors. Now, the company has so far developed 2 products. One is called Vajra, which autonomously tracks and neutralizes hostile drones using kinetic force. And then there's also Hunter, which is spelled as HANTR, which are small UAVs designed to non-lethally capture and bring down suspicious drones which are at short range. Now, Goyal says that the acquisition is their first move towards building indigenous defense capabilities alongside the company's long-term mission of developing next-generation civil aviation platforms from India as well. Now, he adds that while both sectors are usually looked at very differently, this acquisition will help LAT build core capabilities in autonomy, in sensing, and in navigation, and all of these in-house. And these are technologies that are common to both defense and to civil aviation systems and the hybrid electrical regional aircraft that the company is developing as well. Now, remember, this also comes 2 months after LAT demonstrated an ultra-short takeoff capability in its first test flight. Even though the aircraft later crashed due to known structural defects, the company says that the learnings from that test will now go into the next version. But the bigger question now is execution. Is that whether LAT can build both a next-generation regional aircraft and a credible defense tech system at the same time, or does that mark a strategic broadening that could stretch focus when a company is still at an early stage? Well, the answers will now lie in how quickly both programs move from promise to proof. Back to you.
All right, Shilpa, many thanks for taking us through those details. Now, on What's Brewing, Vivriti Group is entering its next phase of growth with with a major structural reset. The mid-market focused financial services platform has launched Vivriti Next as its new operating and holding company, bringing together Vivriti Capital's lending franchise and Vivriti Asset Management's private credit business under one unified structure. Founder Vineet Kumar is also putting in 200 crore rupees of his own capital into the new entity. A strong signal of conviction with a 15,000 plus crore rupee portfolio and ambitions that now go beyond lending into advisory, capital markets and ESG solutions. Is Vivriti now building India's next big mid-market financial powerhouse? Joining me now is Vineet Sukumar, the founder and MD of Vivriti Next. Vineet, thank you so much for taking time out and being here with us on Startup Street. You know, it's great to have you back on the show. Vivriti Group has now created Vivriti Next, right? And it's a unified operating and holding company. What was the reason or the rationale behind this move?
So hi, Arundhati. Thanks for having me back. I think when we set the group up around 8 years back, our objective was to build lending solutions as a first step of accessing the mid-market ecosystem. Today, we've come a long way in that journey by growing to 15,000 plus crores of portfolio and lending and investing in more than 600 enterprises. It was time for us to reflect and think that for a complex ecosystem like mid-market, where the needs are well beyond just money, how could we leverage the ecosystem that we have built by offering advice, by offering capital market solutions, by offering technology, by offering risk, ESG, and other aspects of what we do, to enhance our portfolio, to build stickiness, to build profitability for our group, as well as to build much more relevance for the ecosystem that we are in. So I view this as a very natural evolution where we began with lending, we started investing, and today we offer a much higher bouquet of products. To bring it all together, we incorporated Vivriti Next. We went through a corporate reorganization, which goes live on the 1st of April 2026. And from that point of time, the set of services and products that we offer to our clients will just multiply, making us much more relevant to this marketplace.
So making you more relevant to this market. You know, you've personally invested 200 crore rupees into Vivriti Next, right? We're running out of time. So if you could quickly tell us, what message does this sort of send to the market? How does it change the group's capital strategy going forward? And how do you plan to use the funds?
So Arundhati, I think for the second time in 9 years, I've gone absolutely all in. I think that's the strongest signal to the market, that this is a business model that is going places. It's exciting. It's an amazing place to build great value. And therefore, my signal to all stakeholders, be it investors, be it lenders, be it our clients, is that this is a business I truly believe in. And I believe that for the next 10, 15 years, there's only one direction this is going, which is up.
So you're all in, and there's only one direction that it's going in, which is all up. But Vivriti began as this mid-market lender, right? With Vivriti Next, as you pointed out, you're expanding into advisory, ESG, and capital market solutions. How do you sort of ensure this doesn't dilute focus from the core lending franchise?
That's a great point. And I think if I express our focus a little better, on one side, the target market is mid-market, which does not change at all. And the second is that where we are competent is fixed income and credit, right? And therefore, even our advisory opportunity that we see is going to be oriented around mid-market and credit, which allows us to add value from the knowledge capital that we have built very carefully over the last 8-9 years. For example, we've had an ESG practice of our own for the last 4 years, right? We access capital markets very actively for ourselves for the last 5 years. And we are trying to therefore leverage upon capabilities that we have built for ourselves to address the needs of a much wider set of clients.
All right. And going back to Vivriti Capital, right? You've sort of built a 15,000 crore rupee portfolio over 8.5 years. What have sort of been the key growth drivers behind the scale, and how sustainable is that? What are you going to double down on going forward?
Yeah, so I think in every year, new themes emerge in line with how the government is looking at their priorities. For example, PLI, for example, sectors which we think are growing very well. For example, macroeconomic factors like the tariffs now building more clarity for the Indian macro ecosystem. So every year, new themes emerge on where we can deploy our capital. What's also helping us is that this entire space of mid-market private credit is becoming very interesting for Indian private wealth, which means that money is coming in to power us to be able to reach the kind of scale that we want to reach, right? So since the day we started till today, we've been running at well over 50% compounded annual growth rate. Now, naturally, scale is going to catch up with us. So I don't think we can aim for such high numbers going forward. But given the scope of what we can do, 30% is a fairly comfortable number for us to aim for the foreseeable future.
All right. All right. And in 20 seconds, with private credit gaining momentum in India, how do Vivriti Capital and Vivriti Asset Management sort of complement each other under this new structure?
Great question. So Vivriti Capital does what is vanilla, which is simple capital expenditure, working capital, leasing, bill discounting solutions for our clients. Vivriti Asset Management acts the structured credit element, which is, for example, shareholder corrections, which is, for example, mergers and acquisitions, strategic control transactions, flexible capital. So in a way, these two are complementary and operate side by side to be able to give our mid-market entrepreneurs what they need.
All right. That's a great, concise way of putting it. All right, Vineet, thank you so much for joining us on the show, and we wish you all the best as always.
Thank you.
And moving on, India's grocery market is at an inflection point as urban incomes rise and consumers shift from basic staples to healthier, premium food choices. A new breed of food retail is emerging. NCR-based Elixiir Foods has just raised $9 million in a seed round led by 314 Capital and Incubate Fund Asia to build what it calls a destination-led tech-driven grocery platform for urban India. With veterans from Walmart, Metro and Titan at the helm, the startup is betting big on trust, private labels and farm-led sourcing. But can it crack the razor-thin margins of grocery and build the next category-defining food brand? Let's find out. Joining us now on the show is the founder of Elixiir Foods, Arvind Medirata. Arvind, thank you so much for taking time out and being here with us on the show. You know, you and the founders have spent decades running some of the largest food and retail businesses globally, right? What sort of gap did you see in India's grocery ecosystem that convinced you that this was the right time to build Elixiir?
Thank you, Arundhati, for having us on the show. So I will say, having spent more than 30 years in the food and grocery space in India, we are realizing that as the per capita income of India crosses $2,500, people are no longer looking for basics. They want to eat healthier food, wholesome food. They want to experience authentic cuisine, not just from different parts of India, but also from around the world. And they're looking for absolutely fresh food. So we want to position Elixiir Foods as the most trusted destination for fresh, healthy, wholesome, and gourmet food. The important thing, though, is that we want to do this at wow prices so that this whole category is accessible to mass majority of the Indian population. So we think the total addressable market is almost like $100 billion. And the total customer segment that we're talking about is like 150 million customers. So it's a big market.
It's a huge market. Absolutely. It's a big market and you're looking to target this premium, healthier food segment, right? What sort of behavioral changes are you already seeing on the ground where you're convinced that consumers are moving towards this?
See, I will see that if you look at the onset of the D2C brands in India across different categories, whether it's ghee, people now are conscious about the kind of ghee that they use, A2 cow ghee, ghee cow ghee. People are looking at khapli atta. People are looking at minimally processed snacking options. People are looking at millets and ancient grains. Even if you look at customers from the point of view of, I will say, sourcing, they want green leafy vegetables sourced directly from their farms or from farms. So people want minimally processed, healthier options. And we're seeing a lot of plethora of D2C brands which have mushroomed in this space in the last 5 or 6 years. So we think there's a huge opportunity for a player which is basically covering all the categories, not just produce, but also meat, chicken, dairy, poultry, seafood, staples, which is all the attas, spices, cold press oils. I think that's a great opportunity. And we believe with our past experience that we have, we can make something affordable, accessible to customers without compromising on quality. The time has come for us to change the narrative from 10-minute delivery or 20-minute delivery and, brands for less to quality food. We cannot control the air that we breathe. Sometimes there's a problem with water, but Absolutely. At least our option is to make people in India eat healthier food.
The quality food, a healthier food at affordable prices is what you're looking at doing. You've raised this $9 million at this seed stage. What are the first 3 priorities for this capital? And how quickly do you plan to move from concept to meaningful scale?
See, I will say that we want to move ahead pretty quickly. Our focus is currently on Delhi NCR. We want to build a tech-enabled omni-channel platform. So we're looking at both retail stores as well as e-commerce capability to make the products available to the customers in Delhi NCR. And private label will be a very big part of our strategy. In the past, for many companies, private label has been a poor Me Too cousin of the leading national brands. We believe that private label will be really top in terms of quality. It will be far better than the quality being offered by some of the leading FMCG brands. And private label will be a huge chunk of our sales. It probably will be 60 to 70% of our total sales volume. And we will be sourcing directly from the farmers. We will also be setting up our own back-end facilities for private label manufacturing. We'll have very tight quality specs. We will get the products tested for pesticides, for being free from pesticides. So all the claims will be backed with solid data and technology. And I honestly feel that people in India are waiting for an opportunity like this.
People in India waiting for an opportunity like this. In 30 seconds, urban grocery is crowded. What's your moat here?
The moat is that, interestingly, nobody talks about healthy, wholesome food, fresh food. So we will be the gold standard in terms of fresh food, and we will be the gold standard in terms of healthy, wholesome food. At the same time, we want to be the ultimate party store. We have seen this trend that if you look at the millennials and Gen Zs, they will eat healthy food, they'll exercise a lot, but over the weekends they want to party. So if people are looking for authentic cuisines, let's say Malabar cuisine ingredients or from something from Kerala or Tibetan, it will be available in our store. So we want to position ourselves as the ultimate health store as well as the ultimate party store.
So the ultimate health store and the ultimate party store. You're trying to bring a balance to the lives of everybody. All right. Thank you so much for taking time out and being here with us on Startup Street.
Thank you so much. Thank you.
On that note, we'll slip into a short break. But coming up next, on the sidelines of the Founders Forum, CNBC TV18 caught up with two key voices, Sudhir Sethi of Chirate Ventures and Karthik Reddy of Bloom Ventures, who have shaped India's startup landscape. Stay tuned to know more about their big bets. Welcome back. You're still with us on Startup Street. Profitability, public listing and longevity of the business are taking center stage for venture capitalists when they invest in startups. We spoke to two key voices shaping India's venture and startup landscape on the sidelines of the Founders Forum India. Here's Chirati Ventures and Bloom Ventures outlining their big bets in the startups ecosystem in India.
I think the market will get activated even more, especially for technology companies emerging out of India with patents, and in our portfolio we have so many of them. Miko is one, Kavli is one in IoT space, Miko in the air robotics space, and I can name many more as such. Pixis, Unifor, Aether in the robotic space again for prosthetics. So we've had a fair share of high-tech companies which we have funded, and I think that will grow more and more.
Is focus also shifting to like defense, climate, semiconductors?
We have companies in space. We are looking for companies in defense. We are looking for companies in the whole space of climate. We have a company in climate called Kebicol.
Of the over 140 companies, how many are unicorns?
8 so far, but I mentioned to you earlier, I think unicorn was an investor funding, let's say, achievement, which necessarily did not mean that there was enormous substance for longevity of a firm. Post-COVID especially, I think investors and founders have understood that unicorn label is not necessary. What is necessary is the firm really progressing.
When it comes to investing in these startups and when they go public, is it becoming harder for investors to exit after the IPO and after the listing?
I think when you exit, any investor has to have alignment with the founders, because exit is important to investors. There are many modes of exiting. IPO, for us, secondaries has been big. IPO is number 2 and M&A is number 3. We've accomplished 18 M&As in the last 14 years. As we move forward, I think that ratio will remain. Secondaries will continue to grow. IPOs will grow further. However, as technology investment takes place, deep tech investment takes place, and that's over the next 10, 12, 15 years, M&A will have primacy overall, because M&A success is not just revenue and profit. In a shorter time frame, it is patents, it is pre-monetization of a patent or a technology.
Almost all our investments for a 10-year cycle are made in the first 3 years. Everything after that is follow-on or exits. So in the 4th year, it's not a part of this fund cycle, it's a part of the next fund cycle. So when you tell me, have you built a well-curated portfolio, I have to think through it from a 3-year design perspective, not 3 months or not 5 years.
How patient are you when it comes to the growth of the company, particularly about profitability?
So some of this caution allows us to eat up the first 2-3 years of time that you usually used to take, where you'll run out of patience, because the founders are still figuring stuff out, the product market fit doesn't work, they pivot. A lot of that noise is there deliberately in a design of a startup for the first 3-4 years. In a lot of cases, we are entering after 2-3 years. So we killed that part. On the other side, if you didn't educate your founder ecosystem to say that the eventuality of this business model is profits, IPOs, M&As, public, giving capital back, then you would have been doing an injustice.
What is the timeline that you keep in your mind
7-8 years.
for a company to hit profitability?
Or public, one of the two. We've been more patient with the rest of the lot, and now for the first time, the Fund 2, Fund 1 companies which have hit a certain scale are planning to go public. So the Turtle Mint will be our first. So DRHP is approved. It's an insurance distribution company. It goes public in less than 2 months from now. So that'll be our first main board IPO. So it's a momentous occasion for us. We think Cashify, Intercity, Battery Smart, Purple, Spinny, potentially Ultrahuman, Class Plus, Leverage, maybe Exotel, IDFI, all in the next 2.5-3 years.
Do you discuss with founders about cost cutting? We're seeing so many job cuts across startups. So what are your discussions like? I mean, does it bother you, or do you want them to cut costs?
No, I'm not. You got to be just objective about it. I don't think you're emotional about it, right? If the business doesn't survive, so it goes to the classic analogy. If you're in the plane, they say you first put the mask on yourself, not on your child. right? And if you don't survive, there's no point of like trying to make the other one survive, right? And so, so the question for everybody, all stakeholders and job cuts feel harsh, but I think everybody knows the odds when they're coming into a job, that this is a highly volatile, high-risk environment. That's what you get paid for, right? If you wanted the predictable, sustainable, 10-year thing, you would be in a different company. You wouldn't enter startup land. Door says caution. So you can't have it both ways, right? If you're riding stock option value and you're riding a high pay, your intense environment, that's a trade that you made, right? So I'm not that sympathetic either which way.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.